What if the recession everyone has been waiting for has already arrived, but almost nobody is willing to admit it? Danielle DiMartino Booth has issued a warning that could completely change the way investors, business owners, and ordinary families see the American economy. Behind the reassuring headlines, hidden beneath strong market performance, a very different reality may already be unfolding. If she's right, then the biggest economic story of this decade isn't about what is coming next. It's about what has already begun. And by the end of this video, you'll understand why millions of people may already be living through a downturn without ever hearing those words officially announced. Welcome to Next Alert. If you appreciate calm, fact-based analysis that helps you stay prepared instead of surprised, please consider subscribing to the channel. It would mean a great deal, especially to those of you who have followed economic cycles and know that experiencing is often the best teacher. Before we begin, tell us in the comments, which country and city are you watching from today? We'd love to know where our viewers are joining us from. Every economic cycle has one defining moment. It is not when the government officially declares a recession. It is not when television networks begin flashing alarming headlines. And it is certainly not when financial analysts finally agree on what is happening. The defining moment arrives much earlier, when the evidence quietly begins to accumulate while most people are still convinced everything is normal. That is exactly the warning Danielle DiMartino Booth has been making. According to her analysis, America may already be living through an economic downturn. If that sounds difficult to believe, consider how recessions have unfolded throughout history. They rarely announce themselves. Instead, they spread gradually through the economy, affecting households, businesses, and financial institutions long before the official statistics catch up. This creates a dangerous illusion. On one side, stock market indexes continue attracting attention. Corporate earnings from a handful of giant technology companies dominate financial headlines. Government officials continue speaking about resilience and stability. Investors searching only at the surface may conclude that the economy remains fundamentally strong. But beneath those headlines, another picture begins to emerge. Businesses are becoming more cautious with hiring. Consumers are growing increasingly selective with spending. Banks are tightening lending standards. Families are finding it harder to save money at the end of each month. None of these developments individually confirm a recession. Together, however, they begin forming a pattern that experienced economists recognize all too well. The labor market provides one of the clearest examples. Employment reports often appear encouraging when first released. Financial markets react within minutes, believing the economy remains healthy. Yet months later, many of those same reports are quietly revised downward. By then, investors have already moved on to the next headline, while their revised numbers receive almost no public attention. This delay matters because employment is one of the most important measurements of economic health. If job growth is consistently weaker than originally reported, then policymakers, businesses, and investors may all be making decisions based on information that no longer reflects reality. Danielle DiMartino Booth argues that this disconnect is becoming increasingly difficult to ignore. Even beyond employment statistics, another warning signal has begun flashing across the economy. Labor force participation remains under pressure as more Americans stop actively searching for work. On paper, unemployment may appear manageable. In reality, fewer people participating in the workforce changes the entire interpretation of those numbers. At the same time, inflation continues squeezing household budgets. Although the pace of price increases has moderated compared with previous years, everyday expenses remain significantly higher than they were only a few years ago. Groceries, housing, insurance, transportation, and healthcare continue consuming a larger share of disposable income. This creates an uncomfortable reality. Consumers may still be spending money, but increasingly they are spending because they must, not because they are financially confident. Essential expenses replace discretionary purchases. Vacations become delayed. Major household projects are postponed. New business investments become more difficult to justify. Economic slowdowns rarely begin with panic. They begin with hesitation. One cautious purchase becomes another. One delayed hiring decision becomes several. One business postpones expansion, while another quietly freezes recruitment. Before long, these individual decisions begin reinforcing one another, creating momentum that becomes increasingly difficult to reverse. The most important question is no longer whether isolated warning signs exist. The question is whether those warning signs are now connected closely enough to reveal a much larger economic story. If Danielle DiMartino Booth's assessment proves accurate, America is not standing at the edge of a downturn. It may already be walking through one. Economic downturns do not begin on Wall Street. They begin around kitchen tables. Long before economists debate whether the country has entered a recession, millions of ordinary families quietly begin changing their behavior. They stop replacing aging appliances. Weekend vacations disappear from the family budget. Restaurant visits become less frequent. Small luxuries that once felt routine suddenly become difficult to justify. These decisions rarely make headlines, yet together they become the first unmistakable signal that an economy is losing momentum. Danielle DiMartino Booth argues that this is exactly where America's real economic story is unfolding. Not inside government press conferences, but inside households struggling to balance income against expenses that continue moving in only one direction. For years, consumers acted as the engine powering the American economy. Nearly 70% of U.S. economic activity depends on consumer spending. As long as households continue buying homes, cars, electronics, vacations, and everyday goods, businesses keep hiring, factories keep producing, and investors remain optimistic. But what happens when that engine begins running out of fuel? The answer can already be seen in several corners of the economy. Personal savings have fallen toward levels that leave little room for financial emergencies. Many families who accumulated savings during earlier stimulus periods have now exhausted those reserves. Instead of paying with cash, more households have turned to borrowing simply to maintain their standard of living. Credit cards, once viewed as short-term financial tools, have quietly become survival mechanisms for many Americans. Groceries, gasoline, utility bills, medical expenses, items that were once covered comfortably through monthly income are increasingly being financed with revolving debt. This strategy can work for a short period, but every additional month brings higher interest payments, making recovery even more difficult. Then comes another warning sign: auto loans. Across America, monthly vehicle payments have reached levels that would have seemed unimaginable only a decade ago. For many households, transportation is no longer just a necessity. It has become one of the largest monthly financial obligations after housing. The consequences extend far beyond the automobile industry. When a family commits over $1,000 each month to a vehicle payment, discretionary spending inevitably shrinks. Money that might have supported local businesses, restaurants, travel, or retail shopping instead flows towards servicing debt. One household making that adjustment changes very little. Millions doing the same begin reshaping the entire economy. Businesses notice the slowdown before government agencies do. Retailers observe fewer customers walking through their doors. Manufacturers receive smaller orders. Small business owners delay hiring another employee because sales no longer justify expansion. Large corporations respond differently. Rather than announcing dramatic layoffs immediately, they begin implementing hiring freezes. Vacant positions remain unfilled. Expansion projects are postponed. Departments are instructed to reduce operating costs. To the public, everything still appears relatively normal. Employees continue going to work. Stores remain open. Financial news continues discussing stock prices. But beneath the surface, confidence is quietly disappearing. Perhaps the most troubling development is the sharp increase in business bankruptcies. Small businesses are often the first casualties during periods of weakening demand. Unlike large corporations, they possess limited financial reserves and less access to affordable financing. Rising borrowing costs, weaker consumer spending, and higher operating expenses create pressures that many cannot survive indefinitely. When local businesses close, communities lose more than storefronts. They lose jobs. They lose local investment. They lose future opportunities. This creates another wave of economic weakness that feeds back into household finances, reinforcing the cycle Danielle DiMartino Booth believes is already underway. History shows that recessions rarely begin with dramatic market crashes. More often, they begin with something far quieter. A family postpones a purchase. A business delays an investment. A bank tightens lending standards. An entrepreneur decides to wait one more quarter before expanding. Each decision appears insignificant on its own. Collectively, they become the invisible chain reaction that transforms isolated financial stress into a nationwide economic downturn. And if those patterns continue spreading across the American economy, the next phase of this story may not simply involve slower growth. It could force policymakers, investors, and businesses to confront a reality they have spent months trying not to acknowledge. History has a habit of repeating one costly mistake. Just before major economic slowdowns become impossible to deny, financial markets often look surprisingly calm. Investors continue buying stocks. Government officials continue delivering optimistic speeches. Economic commentators debate whether the next interest rate decision will boost markets. Meanwhile, beneath that appearance of stability, the foundation is quietly beginning to weaken. Danielle DiMartino Booth believes this is one of the most dangerous stages of any economic cycle, not because the risks are invisible, but because they are being overshadowed by distractions. The modern economy has become remarkably skilled at masking structural weakness. Strong performances from a handful of trillion-dollar technology companies can lift entire stock indexes, creating the impression that corporate America is thriving. Yet stock market performance and economic health are not always the same story. A family struggling to afford groceries does not benefit because a technology company reaches another record valuation. A small manufacturer facing declining orders does not become more profitable because artificial intelligence stocks are rallying. Wall Street measures expectations. Main Street measures reality. And when those two worlds begin moving in different directions, history suggests the gap rarely remains open forever. One of the biggest reasons for this disconnect is monetary policy. The Federal Reserve faces an increasingly difficult balancing act. Inflation remains a concern, but signs of slowing economic activity continue appearing across multiple sectors. Lowering interest rates too early could reignite inflation. Keeping rates elevated for too long could place even greater pressure on households and businesses already struggling with higher borrowing costs. There is no painless solution. Every policy decision now carries significant consequences. Businesses that borrowed heavily during years of ultra-low interest rates are discovering that refinancing debt has become dramatically more expensive. Commercial real estate owners face higher financing costs, while office vacancies remain elevated. Smaller companies dependent on bank lending encounter stricter approval standards than they experienced only a few years ago. Credit, often described as the lifeblood of the economy, begins flowing more slowly. And when credit slows, economic activity follows. Housing offers another revealing example. For decades, real estate represented one of America's most reliable engines of wealth creation. Rising home values encourage spending, construction, and investment. But today's environment presents a different challenge. Mortgage rates remain high enough to discourage many potential buyers. Existing homeowners hesitate to sell because replacing a low-rate mortgage with a significantly higher one would dramatically increase monthly payments. The result is an unusually frozen housing market. Transactions slow, construction projects become more selective. Related industries, from furniture manufacturers to home improvement retailers, begin feeling the effects. This is how downturns spread. Not through one catastrophic event, but through dozens of interconnected sectors gradually losing momentum. Meanwhile, government borrowing continues expanding. As national debt grows, so do interest expenses. Every increase in bond yields raises the cost of financing that debt. Money that could have supported infrastructure, education, or economic development is increasingly directed towards servicing previous borrowing. The burden compounds over time. Investors understand this. Global bond markets understand this. Eventually, policymakers must confront it as well. Perhaps the most underestimated risk is timing. Markets rarely wait for official confirmation. By the time economists formally recognize a recession, asset prices, corporate earnings, and investor confidence may have already adjusted to the new reality. This explains why experienced investors spend less time debating definitions and more time studying trends. Danielle DiMartino Booth's warning is built on exactly that principle. Rather than focusing on a single economic indicator, she examines how employment, consumer behavior, credit conditions, housing, corporate decision-making, and financial markets interact with one another. Viewed individually, each signal may appear manageable. Viewed together, they begin forming a picture that is far more difficult to dismiss. The greatest danger is not simply that America could enter a deeper downturn. The greater danger is that businesses, investors, and policymakers continue making decisions based on yesterday's assumptions, while tomorrow's economy is already taking shape. Because once confidence finally breaks, economic adjustments rarely happen gradually. They happen all at once. And the next chapter of this story may determine not only how severe the downturn becomes, but who is prepared to survive it. Every economic cycle eventually reaches a point where denial becomes impossible. The warning signs that were once dismissed as temporary begin appearing everywhere at the same time. Consumers cut spending, businesses reduce investment, banks become increasingly cautious, employers stop expanding. Investors suddenly realize that the assumptions supporting their optimism no longer reflect reality. When that moment arrives, the conversation changes overnight. The question is no longer whether the economy is slowing. The question becomes how severe the slowdown will ultimately be. Danielle DiMartino Booth believes that America may already be approaching that turning point. If her assessment is correct, then the coming months will not simply test financial markets. They will test the resilience of businesses, entrepreneurs, and investors across every industry. History offers an important lesson. Every recession eventually ends, but not every business survives long enough to benefit from the recovery. The companies that endure are rarely the ones that ignore warning signs. They are the ones that recognize changing conditions early enough to adapt. They preserve liquidity. They manage debt carefully. They avoid expanding based solely on optimistic forecasts. Most importantly, they prepare before uncertainty becomes panic. That same principle applies to investors. During periods of economic expansion, chasing returns often becomes the dominant strategy. During periods of contraction, protecting capital becomes equally important. This is one reason why defensive assets frequently attract renewed attention whenever confidence in economic growth begins to weaken. Gold has historically occupied a unique position during periods of financial uncertainty. Unlike corporate earnings or consumer spending, its value is often influenced by confidence in monetary systems, real interest rates, and perceptions of economic stability. Danielle DiMartino Booth has repeatedly suggested that prolonged economic weakness, rising credit stress, and slowing growth could create an environment in which investors reassess traditional portfolios. That does not guarantee higher prices. Markets never move in straight lines. Short-term volatility can be significant, particularly when investors sell profitable assets to cover losses elsewhere. However, history repeatedly demonstrates that prolonged periods of economic uncertainty often encourage greater interest in assets perceived as stores of value. The same logic extends beyond precious metals. Entrepreneurs may discover opportunities where others only see risk. Companies with strong balance sheets may acquire weaker competitors at attractive valuations. Businesses that focused on efficiency during prosperous years often gain market share when competitors begin struggling. Economic downturns reshape competitive landscapes. They reward preparation more than prediction. Perhaps the greatest mistake would be assuming that this cycle will unfold exactly like previous ones. Today's economy faces challenges that earlier generations did not. Government debt has reached historic levels. Artificial intelligence is rapidly transforming labor markets. Global supply chains remain vulnerable to geopolitical tensions. Central banks possess fewer policy options than they once did after years of extraordinary monetary intervention. Each of these factors increases uncertainty. Together, they create an environment where flexibility becomes one of the most valuable strategic assets any business or investor can possess. The most successful decision makers understand that uncertainty is not something to fear. It is something to prepare for. That preparation begins with asking difficult questions before circumstances force uncomfortable answers. Is consumer demand becoming structurally weaker? Can businesses continue absorbing higher financing costs? How sustainable is government borrowing if interest expenses continue climbing? And perhaps the most important question of all, what if Danielle DiMartino Booth's warning is not an early prediction, but a description of the economy America is already living through? The answer will not be found in a single jobs report, one inflation reading, or the next Federal Reserve meeting. It will emerge through thousands of individual decisions made by households, businesses, lenders, and investors over the months ahead. Those decisions will determine whether today's slowdown stabilizes or evolves into something far more significant. For entrepreneurs, investors, and business leaders, the objective is not to predict every headline. It is to understand the underlying direction before everyone else finally sees it. Because history consistently favors those who prepare early, not those who react late. And if this economic warning proves accurate, the next chapter of America's economy is already being written. The only remaining question is who will recognize it before the rest of the world does.